So here, so whenever we have a closing stock left, instead of sales minus purchases, it's going to be sales minus cost of goods sold. And how do we find out cost of goods sold? Cost of goods sold, the formula for it is purchases minus closing stock. So we'll find the cost of goods sold, because in effect the stock that we have left is our asset, and we should not be deducting it from sales because we have actually not sold that good, which will be selling it in the next year. So in order to to kind of like find out the actual profit that we made from goods sold, we should only include the purchases of the purchases or the cost price of the goods that we actually sold. So hence purchases minus closing stock will give us cost of goods sold. So this is how then it would look. The our working, so purchases less cost of stock will give us cost of goods sold, which we would then deduct from sales. So the formula for gross profit, sales minus cost of goods sold, and we'll find a gross profit. Now, this also, because we've always been doing double entry for everything, these profit calculations would also require us to make a few entries in our accounting system. The way we would go about it, there would be the entries would go in these manner. So sales, it's already sales is all we need to close off the few accounts to transfer it into trading account, from which we would obtain a gross profit figure. So sales is always credited. So to close off that account, we would add all the sales on the credit side, and we would debit the account by the same amount. So we would debit sales, and whenever we are debiting sales, we need to have a credit entry. The credit entry would go to a trading account. The second entry would be to close off the purchases account. Purchases balances are generally debited. So we would add all the purchases balance, and the difference, whatever the amount is, we would credit that purchases account to close it, and the double entry would be to debit the trading account. uh, and the last one, for closing stock generally, so the way to obtain the figure for closing stock would be to manually count the number of stock items left and multiplying it by the cost price to find the closing stock. Now, there is no entry for closing stock, and to make an entry of closing stock in the financial statements, because closing stock is an asset, we would debit the closing stock account and we would credit the trading account. So if we look at it, so the trading account would then have these. So when we credited, we debited sales and we credited the trading account, we would have credited purchases and debited the purchases account. For closing stock, we debited the closing stock account and we credited the trading account. Now we have to Now, as a result of this, what do we obtain? We obtain the gross profit. So whatever the balance is, instead of writing balance brought down, because generally profit is just calculated for the period and you don't carry it forward to the next year in the same account. So we would just close off the trading account and write, instead of balance brought down, as we did in chapter 5, we would write the gross profit amount. So the difference between when we add sales and closing stock and we subtract purchases from it, the difference of 12,500 would be a gross profit. And we will write it as gross profit instead of balance brought down. And you can see the corresponding entries of sales. So this is how we kind of like do. So the sales balance that we had was credited, and we debited it. So you could look at all the double entries of that we put in the trading account. Okay, so now moving on, once we have the trading account, this is how the trading account would look. Now, so another thing that we would add from now on would be, instead of just gross profit, because you see, whatever figure we have, like balance brought down, we used to carry it to the next period. Here, because we're closing off the accounts, we would transfer the gross profit transfer to profit and loss account. And when we make a profit and loss account, which would include all other expenses which do not relate to the actual cost of goods sold, so all ancillary expenses, which are the general expenses, we would subtract, we would plot it in the profit and loss account. So we'll transfer the gross profit from trading account to profit and loss account because it's a profit. Because it was credit here, it was debit on the trading account. We will credit it in the profit and loss account, and in the profit and loss account we'll write gross profit transferred from trading account. So we have credited profit and loss account. We will now list here all different expenses that we have incurred. So we'll write them line by line. If there is any additional revenue that we incurred apart from goods sold, we'll write it here on the credit side because it would be an increase in a profit. And then we would try to close the account of profit and loss account like we did when we balance off accounts. So we would add both the sides, and whichever is the bigger side, we will subtract the smaller amount from that, and wherever the difference is, we'll plot that difference in order to make them balance. So if the difference is on the debit side, it results in net profit. However, there might be instances when the debit side is bigger than the credit side. So we will have to put a figure here on the credit side, which would mean that there is a net loss, which would mean that the expenses were greater than the profit or the sales amount, and hence there was a loss. But whenever it's a profit, it means that the gross profit plus any other service income was greater than the expenses. So this is basically how profit and loss and trading account work when we use the double entry system. So in order to this just then kind of like tells you how to close off the individual rent and lighting expense, general expense amounts. So whatever we would add whatever expense items we had for the year or the month, and then we would have a final balance. This final balance we would then transfer it to profit and loss account by crediting the rent and debiting profit and loss account. Similar for lighting and general expenses. Now, this is how we kind of like summed up how the trading account and and loss account would look in a T format, and what double entries would go in order to close the account. Now we'll come up to an actual trading and loss account. Generally, trading and profit and loss account are not in the T column here. They're generally in a tabular format, which means like they are in a running format rather than the page divided into two. So whenever we have a trading and profit and loss account like this, we will always start with the sales, which would then we would add it here. Then we'll have another column to kind of like show sub profits, so like sub amounts, which would then add and have a final figure here. So sales less cost of goods sold. We'll break down the working for cost of goods sold, which is purchases minus closing stock. Whatever balance we have, we'll write it in the final column so that we know it's sales minus closing stock, and this will lead us to gross profit. Instead of then kind of like transferring as we did here to another profit and loss account, we just continue on, and we would subtract all the expenses here. This would, because this is like a subtotal column, we'll write it here. Then we'll have a total which would go under the gross profit, which would be subtracted, which and this would lead us to a final net profit income. Now these expenses can be more or less based on different organizations. So if here, for example, if an organization had an income apart from the sales, it would go below gross profit, and if it's just one income item, it will go directly below gross profit. But then if there are multiple items, we'll write the subtotals in this column, and then we'll total add a total here in this column. Same for expenses. There could be just one expense or there could be multiple other expenses, but we'll just write it here in the subtotal column and then add it here. So that's how we would draft up a trading and profit and loss account for different users to understand and present. Now we have the net profit figure. Now, just like as you can see, the net profit figure that we have here is just one element of it. Like the gross profit figure that we had here, we transferred it to profit and loss account. But the net profit figure that we have not transferred it to anywhere. And remember, we are using the double entry bookkeeping system. So there should always be the second aspect. So if there is a debit here, there should always be a credit somewhere. Now, if we understand the net profit idea, it means that whatever the owner has invested, net profit is sort of a return to the business, to the owner's investment. So the net profit should then technically be going to the owner as a return for his amount of investment that he invested in the business. So it can we can then easily say that net profit is an increase to the